Hey, what's up, guys? It's Jordan with the Laundromat Resource Podcast. This is show 162. And actually, I'm really pumped that you're here today because today is probably one of the most valuable episodes that I've ever done. I'm talking with Scott Snow today, and we talk taxes, which, listen, don't get me wrong here. I know that can sound really boring. However, so much of our money goes towards taxes. And Scott and I talk about some different things that you can do to proactively plan out your tax saving strategy. So as you are making money in your business, or as you're planning to make money in your business, you're trying to buy your first one, this is one of the most valuable episodes that you can actually listen to, because there's so many just practical tax tips to help save you real dollars. This is going straight to the bottom line for you. So super good. And today's fast lane tip is even better, which is that Scott and I are going to be doing a live Q&A on Wednesday, July 17th, 2024, 4 p.m. Pacific, 7 p.m. Eastern. So come and join that. Ask your tax questions. We're going to be talking about all kinds of things tax related, but let me give you a highlight of a couple of things that we talked about in today's episodes. We talked about entity structure, which I get asked about a lot. Should I do an LLC, an S Corp, a C Corp? Should I do it on my own name? We talk about that. We talk about passive versus active income. We talk about tax deductions. We talk about depreciation. We talk about tax planning for if you're planning on selling your business, a proactive tax plan. I mean, we just talk about a lot of really good stuff today. So again, this one's going straight to the bottom line. So I hope that you enjoy it. And then I hope you join us for the live Q&A with Scott talking taxes on Wednesday, July 17th, 4 p.m. Pacific, 7 p.m. Eastern. If you want the info for that, you can subscribe on the YouTube channel and also check out laundromatresource.com/events to, see when this event is and every other event that we do. We do all kinds of different webinars, Q&As, all kinds of stuff that we got going on over there. So check out laundromatresource.com/events. All of the links from today's episode will be in the show notes page, which will be at laundromatresource.com/show 162. Or if you're on YouTube, it'll be right there down below. So on your way down there, hit that like button, maybe subscribe if you haven't yet. And let's get into it with Scott. Scott, thank you for coming on the show, man. How you doing?
I'm doing great, Jordan. I'm excited to be here.
I'm excited to have you, which I was just telling you, I never thought I'd be saying about talking about taxes, but I am excited. We talked yesterday, just kind of preparing for this, and we came up with in my mind, a very exciting roadmap for today's episode. And one thing that always sticks out to me, this is genuinely why I'm excited. Well, number one, you're like the best guy ever to talk taxes about, because you actually like taxes and you're enthusiastic. But the other reason is because, I heard this or read this or saw this somewhere at one point, and it just was like a light bulb that clicked on me. It was like, one of the best things you can do to grow your wealth is to get a hold of your taxes. If you can reduce your taxes, you're getting like an instant 30% return on your money right there. Right. And that's like unheard of. It's hard to find investments that give you a 30% return on your money. So it's so important that we pay attention to our taxes. So not to hype it up too much, but because it still is taxes, but I am excited about that, because I do think that this topic is probably one of the most valuable topics out of any of the episodes, really. So
yeah, you're totally right, Jordan. The idea you can reduce your tax just by a few percentage points. That's the idea of keeping more money in my pocket that I then can invest and do other things with. And so if you're trying to grow your wealth over time, that just exponentially makes it go faster. I mean, there's no doubt about it. Taxes are usually everyone's biggest expense every year is your taxes. And so if you can figure out a way to make that go down a little bit, we want to try to do everything we can to make that happen.
Yep. Love it. Love it. Well, before we jump into the fun of talking taxes, why don't you give us just a quick overview? Who are you? Why are you talking to us about taxes? And then we'll jump into it from there.
Okay. Again, nice. I'm Scott Snow. I'm a CPA here based in Arizona. I've been doing accounting and tax work for just over 30 years now. I'm one of those weird guys that really loves taxes. I do. I love it. I love my job. I love the puzzle that it is to put together to help people really reduce that, like I said, the biggest expense they pay. I work for a company, Provision. I'm one of the partners at Provision, and we specialize in really helping people reduce their taxes on a proactive way. It's always typically a lot of people are just reactive to taxes. I get my tax return, I pay or I owe, and I'm done for the year. But we want to take a proactive look throughout the entire year to really help make and reduce, because there's things we can do right now to reduce our taxes each year. Mm-hmm. And that's really what we focus on, is really that reduction of taxes on a proactive way. So, like I said, I'm excited to talk about taxes too, Jordan. It's going to be fun today.
We're going to have a good time. And, I'm curious, just to kick this thing off, are you giving each and every one of us specific tax advice today?
That's a good question. The answer is no, I'm not. Everyone's tax situation is totally different. And what we're doing here is just providing education and general ideas and general tax savings. Like I said, every situation is different. You always want to make sure you consult your CPA and get advice and that's applicable directly to you. We're not endorsing a product or any kind of promoting any kind of investment. All we're doing today is just providing education materials so you can say, okay, hey, these are things I need to bring up to my CPA, or talk to them, or create a conversation that helps you kind of get going on reducing those taxes. But that's true. No one's tax situation is all the same. So everyone's got a different set of facts. And so what we're going to do today is just give some general ideas to try to help.
Yeah, absolutely. And, we wanted to kind of lead off with that disclaimer because, listen, you said it in the intro there. This is a puzzle. There's no one size fits all. I mean, some people can do the TurboTax thing and there's some formulas if your taxes are very simple. But as soon as you start adding some assets, you start owning a business, you start buying real estate, these types of things, you start working for yourself, the picture can become a little more muddled, and there are different things that you can do to optimize your tax strategy. So, some of the stuff we're going to talk about today is universal and just kind of for educational purposes. But it's genuinely I think that it is, if you own a business, it is worth your time, effort, money to invest in a good CPA and a good tax planner to help you maximize your tax savings there and do it all legally.
Yes, you're exactly right. Yeah. That just is, like you said at the onset, saving just a little bit of taxes, just by doing a few little things can make a huge difference over a period of years. If you're looking for retirement in many years, just making the little subtle differences now can make a huge difference going forward.
Yeah, massive. Okay, so well, real quick, I as you were talking, I was just curious. Do you only work with people in Arizona? I genuinely don't know. This is a real question. I'm not setting you up here. Do you work with people all over, or do you only work with people in Arizona?
That's a great question. We have our staff is actually spread out throughout the United States, and most of our clients are in other states. In fact, only a small percentage, I think it's less than 10% of our clients are in Arizona. So we deal with clients all over the country. In fact, we have a lot of clients outside the United States as well. We handle the U.S. stuff. I'm not big on international doing taxes for people internationally, but if we do have clients that live out of the country that have to file U.S. tax returns, we certainly can help with that. So yeah, our client base is all throughout the United States. We file tax returns in every state there is that requires one. So well versed on that, even though our headquarters are here in Phoenix.
Yeah, and this is not this episode is not a sales pitch or anything like that. But we'll include links to get a hold of Scott. If you've got more questions, you want to take a look at your specific particular situation, he'd be happy to do that or have some of his team do that. And then also, I just wanted to mention on the front end here, because I think this conversation is going to spark funnily enough, some excitement in some people about saving some money in their taxes. But we're actually going to be also doing a live Q&A to answer questions about taxes and stuff like that. That also won't be specific advice, full picture. But if you got specific questions, we'll be there to tackle those. That's happening on July 15th. And you can go to laundromatresource.com/events to see when that is and any other events we got going on over there too. So I just want to get that out of the way. But let's jump into it. And I figured you figured we could start from the beginning. I was going to try to take credit for your roadmap, but I'll give it back to you.
That's okay.
We could start from the beginning and let's talk about, one of the questions I get asked all the time is, what kind of entity should I set up, an LLC, an S corp? I know there's some circumstances where a C corp makes sense even for a laundromat. So can we start? I'm going to ask
let's
you
talk about
like
that.
you don't know that you made this roadmap up, but let's start with there.
That's a perfect place to start. So usually when you're starting a business, deciding what type of entity you have is going to be vital. Typically, you set up an LLC. They're the most common right now. They're very easy to set up. You can use one with an attorney to set up an LLC to run your business in. Now, the blessings of what an LLC provides is how it's taxed. An LLC can actually choose how it pays tax. And you do that in the first year. You'll make an election. You can be taxed as a sole proprietorship, which then would be taxed on your personal 1040 on a Schedule C. If you have more than one owner, it could be taxed as a partnership, which would file its own partnership return and give you a K1, which is a statement of how much of that income you need to put on your 1040. Or it could be taxed, as you mentioned, as an S corporation or a C corporation. Both of those could be a viable option. But typically, when you're starting out, an LLC is the way to go. Now, understand when you set up earnings from a business, when you start a business, there's an important thing to remember is that your earnings are going to be subject to regular income tax, but because you own a business, it's also going to be subject to Social Security and Medicare tax. And when you're self-employed, they call that SE tax or self-employment tax. So when you're self-employed, you get bit kind of a little bit on both sides because you got to pay your regular income tax on one side, and then you have to pay this self-employment tax or the Social Security and Medicare portion on the net income as well. Now, as a sole proprietorship or as a partnership, all your income, 100% of it is going to be subject to both of those taxes, ordinary income tax and Social Security Medicare or SE tax. However, as an S corporation, there are things you can do in an S corporation where you elect your LLC to be taxed as an S corporation, which means it files its own separate return, and then the income still flows through and you still report on your 1040. However, there are ways you can save some of that self-employment tax, which is the vital with an S corporation. Now, that's a lot to think about, and I'm speaking generalities there, but the reality is an S corporation for business is usually the best entity of choice, and an LLC can choose to be taxed as an S corporation, which is a great thing. Now, one thing to remember, S corporations have to file their own return, they have payroll, they have lots of extra expenses. So typically, you would want to start out your LLC maybe just as your own sole proprietorship and reporting on your 1040, and then maybe later on down the road elect to be an S corp, which you can do at any time. The reason I say that is because below net income of below $50,000, the S corporation will cost you more than it saves you, which I don't like that. I don't want to spend a dime to save a nickel. I don't want to do that. So typically just set up as a sole proprietorship or a partnership to start out as you're getting going and getting things running. An LLC tax for those is going to be ideal. Then once things start going and your income starts to climb, an S election to make that LLC as an S corporation later on down the road. It can be 1 year, 5 years, 6 months, whatever the time frame is. That income starts to climb, then an S corporation makes the most sense because that'll save you on some of that Social Security and Medicare tax, which always bites people hard when they file their returns.
Yeah, well, and I'm glad I was going to ask you, you're like reading my mind already. I was going to ask you, is there like a threshold where it makes sense to kind of flip that switch there? And so it sounds like that 50,000-ish.
It's around 50K. It's going to be a little different for everybody, but usually that's about that. And that's net income. That's not gross. So that's income less expenses to get down to net income. If that net income is below that threshold, it's just a lot of extra paperwork and extra filings to do to not saving the extra money. And I hate to do that. So usually that threshold, 40, 50,000 is where you start looking at it.
Yeah. But, for people like me who love paperwork, maybe we just want to do it anyway. No, I'm just kidding.
Sure. If you like filing extra forms with the IRS and you enjoy doing that sort of thing, I'm more than happy to do it.
Yeah. Well, so, I mean, the next question then is, why would you ever, or would you ever set up an S corp for your business, not an LLC being taxed as an S corp?
There is, to be honest with you, Jordan, there in some states that does make some sense. It depends on some of the state laws when it refers to LLCs and S corporations. Sometimes S corporations are, because an S corporation, if it's set up directly to start that way, is a corporation at heart. All it is, it's a corporation that is elected to be taxed as an S corporation, which means two things. One, it files its own return. And two, the income flows through and is taxed at the individual tax return level. So an S corporation doesn't pay its own tax. All it does is the income flows through based on your ownership percentage to your individual tax return. That's where it gets taxed, right? So now, in some states, LLC laws are different, and some of the LLC laws are a little challenged in some states. So in some states, an S corporation is directly a corporation, which has been around for eons and has great liability protection, where LLCs in some states have some struggles with liability protection. In those states, maybe an S corporation, just a corporation directly and electing to be an S corporation, would make some sense to start out that way. You're right. There are some states and some particular situations where that would be most appropriate.
Yeah. Awesome. And now, just kind of as a reminder, we're talking from the tax perspective, but is there a, let's say I own multiple laundromats. Huh? Is there tax-wise, is there a benefit to own them all in one or own each one in a separate one? Great question. The answer is, from a tax perspective, no. There's no advantage one or the other. There's no tax savings by having several entities. The only advantage would be maybe some liability different protection. As I'm not a lawyer, and I always joke that I don't play one on TV either. There might be, as you're separating those businesses from each other, be some extra liability protection you may be seeking by having them in separate LLCs or separate businesses, just from a liability standpoint. Mm-hmm. But from a tax perspective, understand that it all gets lumped. Actually, on your 1040, there's a Schedule E on the page 2 of the Schedule E. All the earnings from those businesses that are flow through are all lumped together into one number and flows to your front of your 1040. So there's an advantage to having one have a higher income or putting them all in one. There, honestly, from a tax perspective, there isn't. Okay. Well, and that was going to be my follow-up again from the tax perspective. Yeah. Is there, let's say, for example, you buy a laundromat with the real estate. Is there a benefit to splitting them up there? There is. There actually is in that case when you're doing because you really want to bifurcate the real estate side from the business side, and there's reasons to do that from a liability standpoint as well, right? Because you want to keep your business liability and your real estate liability separate. There's some advantages there to separate that business. From a tax side, obviously, a building and having rental income, if you're renting the building or if there's different things of that nature, that is taxed differently because that's not subject to Social Security Medicare tax, whereas the earnings from the business are subject to Social Security Medicare tax. So they're taxed a little bit differently when it comes to taxes. So there would be an advantage to splitting the real estate piece from the business piece. Most businesses do that just for from a liability standpoint. They're trying to separate that liability. That's very common. Yeah. Just out of curiosity too, and maybe this is getting a little too into the weeds, but maybe you're the weed whacker here. So let's go. Let's whack some weeds. So let's say, for example, I buy a laundromat with real estate. Are there any implications to, a lot of owners when they do this, there's no necessarily a relationship between them. Basically what I mean is there's no lease drawn up between them. Are there tax implications one way or the other of if you own both the real estate and the laundromat of drawing up a lease between those two entities and having one pay the other? You would. Typically, if you're going to split those, then typically your attorney most likely would recommend you splitting the real estate from the business side. Mm-hmm. And when you do that, yes, there would be agreements between the business side to lease the property from the real estate LLC, for example. So it's a great question. So here I have this LLC that owns the real estate. I have an LLC that owns the business. That business is going to sign a lease to lease the property so that I can rent that property out. And then there's a lease agreement between your two entities. And paperwork like that is just super important. I know it seems crazy to say I own both those entities. Do I really need that? You really do, just from a legal standpoint, because in any kind of legal action, you want to make sure your ducks are in a row, your T's are crossed, your I's are dotted, and those kind of agreements are vital for that. So yeah, there would be an agreement, a lease agreement. I have a laundromat, and I'm going to lease the property to put my machines in, and I'm going to pay a certain amount of rent or whatever that rent is based on, and that rent is going to go to my other LLC, and I'm really splitting those entities because I'm splitting them for liability protection because that's what I want. So it's important from a business standpoint, I separate them from business as well.
because I want to lean on that liability protection if something were to happen. And if you start mingling stuff together, the courts are very reluctant to say, hey, now I want to separate them because I'm getting in trouble. If you have them separated and you treat them both separately, you've got much better protection than if you try to things get muddled in the water. So agreements like that are vital.
Yeah. And I'll just throw in too, there are implications to the valuations of both the business and the real estate based on that documentation also. So it behooves you to have that documentation. So if you're out there and you own real estate and the laundromat in that real estate and you don't have a lease, it'd be a good time to go get that going.
Yeah. Contact your attorney. They can write it up for you pretty easily and get something going so we have that just to have the proper documentation in place. That's going to be key.
Yeah. But tax wise are there implications of moving money from my business to my real estate?
There are, because when you go from, understand as an owner of a business, I can take an S corporation or an LLC and some of those businesses, C corporations, let's leave those out for a second. But most of the time I can take money out of my business. It's my money. It's my business money. I can distribute that money out to me. But however, if I go from business to business, well, what is that now? It's not a distribution to an owner. The other business is not an owner. It's got to be classified as something. Is it rent? Is it payment for services for something? Is it something? So moving money between businesses, it's always important to have some kind of agreement of what that is. Is it a loan? Maybe one company you're loaning money to the other company. Okay, which case you'd have some kind of loan document that says, okay, here's the interest, here's the loan amount. I've got to be, so all your things are, like I said, the T's are crossed, I's are dotted in moving money from one business to the other. You always want to know what that is. I know people do it all the time. They say, I'm just going to write a check for $2,000 from this business and give it to that business. Well, your accountant's going to always ask you that question. Well, what was that $2,000? Well, what was it? Was it a loan? Was it something? So you got to be real careful when you're moving money between businesses.
Yeah, I definitely, first year I had a business with real estate and I was like, I actually don't remember what this check is. And he's like, you go figure that out, buddy.
Yeah. I've had people have to contact their bank to get a copy of the check and the deposit slip and try to figure out what deposits are. Yeah. It happens a lot. It's not uncommon.
Yeah. Wow. That makes me feel a little better. It's not really my strong suit.
Understand.
Track all this stuff. So, okay. Anything we need to talk about? I've got one more question on this, but I want to make sure anything else we need to talk about in terms of LLC S Corp?
No, I think we're good on that. Like I said, LLC, then like I said, maybe electing the S Corp down the road is ideal. The LLC just gives us a lot of opportunity and flexibility, right? Because we set up the LLC. We don't have to be an S Corp to the start. We can move on down the road, see how business grows. If things don't pan out, I want to get out of the LLC. It's very easy to do. Once I make that S selection or I'm an S corporation, now I have a lot more things to cancel and get out of. It just makes the life a little more complicated. So yeah, LLC is probably the entity of choice to get started for sure.
Yeah, great. And okay, so my last question is, and it's my understanding that it rarely makes sense to have a C corp. Are there cases for that?
There are cases. Typically, because being an S corporation, even an LLC tax S corporation, there are some limits on who can be owners. Mm-hmm. And one of those limits is that it has to be individuals, right? So it can't be another business, which I can't. An S corporation can't be owned by another business. It has to be only owned by individuals. So that's a little limiting a little bit. Otherwise, it has to be a U.S. person, right? It can't be a foreign person. And so if you have maybe a foreign investor that wants to invest, very hard. They can't be an S corporation because you can't have a foreign owner of an S corporation. So there are times when a C corporation would make sense. In those cases, I have several clients that run businesses that have foreign investors or foreign owners that cannot be an S corporation. So a C corporation makes sense for them. And as you know, in a C corp, it files its own tax return. It pays its own tax. It's a flat rate right now at 21%, as the way it stands right now, plus state tax, depending on where you're at state-wise. And then you have to just getting money out of those C corps. That's where the challenge is. Is it dividends? Is it wages? It's a little easier to get money out of the LLC S corp or partnership. A little easier to move money out. So there are times where a C corporation would make total sense.
Yeah, and I'll throw one more in there. It's the one I probably see most commonly in our industry, and that's when somebody's using what's called a ROBS for a rollover business startup, which is basically using your retirement funds to acquire a a business, a laundromat
Right.
specifically here.
So that's basically ends up an owner, which is not an individual. So yeah, C Corp would make good sense in that case. You're exactly right.
If there are implications that if you're interested in ROBS, definitely talk to somebody who is an expert in ROBS.
Yes, very much so.
Because there are a lot of regulations kind of around that.
I've seen a lot of people get in trouble with those too. Yeah, that's good advice, Jordan. That's really good advice. Make sure you do your homework on those.
Yeah, do your homework. Don't go it alone. Don't go it alone.
That's right. Don't go it alone. Don't do it. Don't do it. It's not worth it.
Yeah. Okay, cool. Well, and I think that's helpful. Well, one more question actually, and I can chime in on this too, if need be, but do you have any recommendation on when in the process should I be forming an entity? Do I need to form it and then go looking for a laundromat, or?
And the answer is either is fine. Typically I like to set up the LLC kind of beforehand. Because then at that point, what I do is, let's say I fund my LLC, I put 10 grand in. So as money's going out, all those monies are going out for business expenses. It's just easier to track, right? So I have a business bank account. I'm spending money out of that business bank account. I have a business credit card or a debit card. It's easy to track that money going out, what those expenses were for, versus without having that, maybe have a separate business account. But if I'm just trying to use my personal account, then I have business and personal stuff all mixed into that account. It's just hard to differentiate some of that stuff. So typically setting up, hey, I'm in the market. I'm going to go out and buy a laundromat. I'm going to set up my LLC. And you're going to usually set that up in the state in which the property is going to be located, where you're looking. And then once you get that, you get your employer identification number, which allows you to then open a bank account where you can put some money in. And then you can start spending money out of that account for expenses that you then, once you buy it, would be able to be deductible.
Yeah. Yeah, and I'll just mention that if you don't set it up beforehand, it's okay. You said, you can do it either. Practically speaking, like let's say you make an offer on a laundromat, you don't have your LLC, your S corp or C corp or whatever done yet, and you make an offer. Typically, the way it'll look on the acquisition side is your contract will say Jordan Berry is buying X laundromat, and there'll be a little clause in there that says and or assigns, and that allows you to, during due diligence or even after, really. Right. But during due diligence, it allows you to form your LLC, S corp, C corp, whatever, and then assign the contract to that entity during escrow. But you can also even do it after the fact.
You're right. Exactly right. There's no really requirement that you have to have it done even before you purchase it. You could buy it in your own name and say, hey, you know what? Now I want to set up an LLC and I'm going to move that over there. You could certainly do it at any time. But you're right there. It does, with that special deal on the purchase contract, allows you the flexibility, because usually it's, not often does it close in like a week, or, it's not going to close in a shorter period of time. So it gives you time to, hey, I'm going to set up my LLC, get the bank account set up, and get ready to go by the time I close. So that's typically what you see happen.
Yeah. And the reason I mentioned that is because I've just seen a lot of people, that's a hang up for them, and they don't get started looking because they're busy trying to get that set up, and it almost becomes a crutch or an excuse as to not move forward. And I would rather you move forward and take care of that as you go, because it's not a critical step to be able to continue to move forward in that process. So
I couldn't agree more with you. I totally agree with that. I mean, like I said, if the deal comes along, make the offer and get the deal going. The LLC, we can get that set up going on through the process here. There's not any limitations. I have to have the LLC first. Not required in any sense of the word. So the idea of just, hey, if you're going out looking and something comes up and you want to make an offer, great. We put in that contract that I can assign it. You can set up your LLC as you go along, and away you go. Yeah, that's good advice, Jordan.
Thank you. I appreciate that. Yeah. That meant a lot to me right there. Let's talk about income.
Yes.
And, passive, active. I mean, what are the different types of income? How does this work with business or other kinds of investments? What do we need to know here?
Yeah, that's a big thing. But especially in a business like the laundromat business, the idea always comes up whether it's considered a passive business or an active business. That's a question I probably get asked more than anything else I get asked questions about, whether it be with real estate or a business. And the answer is, when the IRS, they understand they have just special rules they use. It doesn't really matter how much you think it's involved. Like I know people that work with the real estate all the time, and the IRS still considers that passive. And they're like, how is that passive? I worked there all the time. It's just the way the IRS works. So when it comes to passive and active, typically the drawn sand in the line is 500 hours a year. That's the number, right? If I would do more than 500 hours a year, then I'm what they call materially participating in that business, and it would be considered an active business, right? It's not passive. If it's less than that, then there's some other rules I can maybe get into that, but typically the 500-hour rule makes a difference. Now, why does it make a difference? Why do we care? The answer is this, and I always use a visual because it's just easy to explain. Is you think about income and on your tax return, or you consider it in three separate baskets, right? There's an active basket. That's where your W-2 would go. That would be earnings from businesses, which you're actively involved in. That's an active participation basket. There's a portfolio basket, which is interest, dividends, capital gains from sale of stocks and bonds. That's portfolio. And then there's the passive basket, which would be rent income, royalty income, businesses in which you're not actively involved. That's considered passive. Now, those are the three buckets or baskets that we have. The IRS will allow you to offset gains and losses in any one basket, right? So if I have a passive investment that has a gain and a passive investment that has a loss, I can offset the two of those. What I can't do is take a loss from my passive basket. So let's say I add up all my income and loss in my passive basket, and it's an overall net loss. I can't take that net loss and offset it against my W-2 and my active income. Can't do that. The IRS considers that a passive loss, and it gets what they call suspended, which means it just gets carried forward into the next year. You don't lose it. It's not gone. You just go, hey, I'm going to go to zero, and then the leftover losses that I can't take get carried over into the next year. Maybe I can use them the next year. If I can't use them, I carry them into the next year. They're so-called passive loss carryovers. Right now, so that's the way that works. So if you ever sold a stock or had a big stock loss, you may know that you're limited to my $3,000 a year. I can't take the full loss because that's the same. It's a portfolio basket. I can't take those losses and offset. Now, when it comes to the passive basket, one little catch. There is a way to take, the IRS will allow you $25,000 of passive losses from that passive basket to offset against active income if your income is below $100,000. And then that $25,000 gets what they call phased out between income of 100 to 150. If you're over 150, you get none. Any extra passive losses get carried forward. So that's why this passive active thing is important, because if I'm active, if I'm over that 500 hours, that is considered an active business. It's not in my passive basket anymore. It's in the active basket, right? And that's what determines whether I can take that loss, and like especially with laundromat business. Obviously, that first year, many of you guys are always aware of extra depreciation, extra deductions you can take, and you could create a loss. Well, if I'm not involved 500 hours, it's still a passive investment. That loss is going to get suspended and carried into the next year. So that materially participating and being actively involved is a key point. Is investors think, hey, I'm going to have this huge loss and it's going to offset my W-2? The answer is maybe, if you qualify. And that's a year-by-year designation. So I have to meet that 500 hours each year to materially participate in order to take losses and offset that against my active income.
Yeah. Okay. So let me ask this question because, if I understand correctly, let's say for real estate, for example, to get that real estate professional designation, you need the 500 hours, but I thought they also it has to be the primary.
Well, real estate's a little different.
The most time on that.
Yep.
Is that
you're right?
Is that true with business? That's where I'm getting at.
Yeah, you're right. There's actually I want to separate the two of those. Yeah. In an active business, it's the 500-hour rule to make it active, material participating. With real estate, it's a little different. Because real estate, remember, is always considered passive on an offset, right? And with a business, it's either active or passive. It's one of those two, and it could be either. With real estate, it always starts out passive. So the rules with real estate are a little different. That's what you mentioned, that word real estate professional. And that's that idea is I have to have, that one is actually 750 hours in a calendar year. And the catch one of this one is it has to be more hours in real estate than any other job. Yeah. That's the kicker one. Because if you work full time at your job and that's 2,080 hours, in order for you to be a real estate professional, you have to get the 750, but you also have to have more hours in real estate than your job. So you'd have to have 2,081 hours in real estate. And I don't know if there's that many hours in a year. Maybe there is. That's a lot of hours. So the idea for real estate's different because it's already designated as passive on its own set. There are special rules with that. When it comes down to a business like a laundromat business, it's that 500-hour material participation rule. Hey, am I going to be involved 500 hours? Now, I on the onset, like I said, we're doing education, it's general education. There are some rules that you can still be considered active if it's below 500 hours. And you really want to consult with your CPA on that because there's some special rules you can get in. You have to be more than 100 hours, but more than anybody else, right? So there's some special rules you can get around it. But the one that most people use is the 500-hour rule. I'm going to materially participate. But again, if you're thinking, hey, I want this to be active, but I don't know if I can get 500 hours, certainly talk to your CPA, talk to your tax professional, see if there's any ways I can get around that and still have it be active. Because those losses are big. I mean, that's the big incentive right here, right? If I can get a loss from real estate or a loss from my business and offset it against my W-2 income, dude, that's where you save some taxes. That's the fun part.
Well, and I wanted to make that distinction between the business and the real, because we got a lot of real estate investors that listen to this who are interested in laundromats, and that's a pretty good selling point, for aside from like the cash flow benefits.
Yeah.
Real quick, if you're filing jointly, let's say I'm a laundromat owner, actively, and my wife is a teacher because she was until she just quit. But can those losses from my active participation in the business offset her W-2?
The answer is on a joint return. The answer is yes. That is correct. And like on a real estate professional, on the real estate side, only one of the spouses has to be a real estate professional, and it would offset the income of both of you. So it just has to be one of you. Now, what you can't do, and this is where people I know they try this, is as a couple, it's not 500 hours as a couple, right? Yeah. It's 500 hours as an individual or 750 hours when it's real estate on an individual side. It's not, I can't combine all the time me and my wife both spend on that. Unfortunately, I can't do that. I got to spend the 500 hours to make that active. So certainly it's but yeah, in a joint return, if I'm material participating and I have a business that has a loss, that loss would offset against my spouse's income, certainly. Yeah. Awesome. That's where the savings come.
Yeah. Well, and it's huge. I mean, because it's a massive perk, especially, we didn't really even talk about this, but there's benefits to owning a business, right?
Yes.
And, tax wise, and some of those benefits, for example, are you pay your expenses before you count how much your income is, and then you pay taxes on what's left over. Whereas a W-2, you pay your taxes and then you spend your money, right?
Yeah,
so
that's a huge benefit.
Yeah. And then we've got, depreciation is equipment heavy industry, right? So there's a lot to depreciate. So those losses that we're talking about are real expenses, but also paper expenses on there too, that you can then use to kind of offset that active income if you're active in your business.
You're exactly right, Jordan. The idea of I'm paying tax on after I paid my expenses. That's the beauty of having a business. And it also gives you a place to deduct business expenses, right? Can I do things that can save me money? Because there's a lot of, when it comes to deductions, the rule for deductions are this. It's an ordinary and necessary expense in the course of business. That's what the IRS's definition is. So whatever that is, if it's ordinary and necessary in the course of business, that is a deduction. And so we can start to look at things like travel and home office and all sorts of fun things that you then could take as a deduction that you couldn't get as a W-2 employee, right? So the idea was, as a business owner, you open a whole spectrum of ways to save taxes.
Yeah. And that's it. I mean, listen, that's great. And, listen, you think I'm this beautiful on my own? No, I have this regimented beauty routine that can be necessary because I'm a YouTuber over here, and no, I'm just kidding. No, but it is true. I mean, that is some of the perks of owning this business, right? Like can you talk a little bit more about deductions here and how that benefits us, as a business owner, and maybe some things to kind of keep an eye open for?
Yeah, there's a lot of different things. One of the things I always talk about when we talk about deductions, I always talk about what I call permanent deductions, right? Permanent tax savings. There's a lot of things like retirement accounts and things you can do that are what they call deferred. I'm going to defer the money to taxes to later. And as I say this all the time, I don't do a lot of deferred at ProVision. We don't do a lot of deferred accounts just because that is the whole premise that I'm going to defer tax to later. And so that's the idea that I'm going to retire. When I retire, I'm going to be poor. And when I'm poor, I'm going to pay less taxes, right? I just don't buy that. I don't want to be making less money at 65. I want to be making more money when I'm 65, right? So the idea that I would defer taxes to a time when I'm going to be making more money at a higher bracket, why would I do that? I just don't do that. I don't do a lot of that tax deferred stuff. I don't do it now. There are a time and place for those. There are options for those to doing some of that tax deferred. I don't start with those. That's what I do last, right?
Yeah.
We want to look at permanent tax saving stuff.
Yeah. And it's most people's primary like retirement strategy.
Oh, it is.
Like investing
401k.
strategies.
I invest in my 401k, that invest and pray strategy, where I'm going to invest and pray that it goes up. That's tough. You don't have a lot of control. Whereas doing your own business or real estate, you have some more control of what I'm investing, where I'm investing, what's going on, what expenses I'm taking. That gives you that kind of control is, better than, you invest in some mutual funds and some guy in a suit somewhere in a business in a big city is making a decision whether your fund goes up or down, and you have no control of that. So it's hard.
Yeah. Well, and, I specifically said, hey, can we talk about this a little bit? Because I think it's maybe in real estate, in some business circles, it's pretty common belief, but generally speaking, that's pretty controversial take on things. And I couldn't agree with you more, but it's pretty controversial. And it's, I think probably to some people listening, that is maybe even a mindset shift that they've never even considered.
Yeah.
Because all we hear about is, hey, invest in your 401k. Okay, if you're lucky enough to have a pension, rely on that. We've got Social Security, right? Those kinds of things that'll take care of us. But we're seeing a lot of people retire right now and not have enough money, because of inflation and because they didn't plan well and yada, yada, yada. And having that control over your investments, but also of your future, and not giving that control over to someone else is huge.
And I've been doing this long enough that I've seen the market go up and down many times. Back in the early 2000s, when the market really took a hit and everybody's 401k crashed and everybody was panicked, they were really panicked about that. Now it's gone up and done well in the last several years, but like I said, that again is not really based on what you're kind of doing. It's based on what the other people are doing. So you always have that risk involved. Whereas you own your own business, you own real estate, things where hard assets, you have a little more control, plus a little more just more open for deductions. Like you said, that we onset. If I can take extra deductions and save taxes now, that's more money I can invest in another business or another piece of real estate, or I can invest to help my wealth grow faster. So certainly we always have this little quick saying. I've heard it before, and I've never heard it. You want to change your tax, you change your facts, right? And so changing your tax, you have to do things that's going to change your facts. If I'm just going to be a W-2 owner and I'm going to invest in my 401k, I'm not changing my facts at all. And so the opportunities for me to change my tax, very limited. Where I go out, I buy a piece of real estate, I invest in a business, I invest in a laundromat business. Now I'm changing my facts. Now I have some opportunities to really put in some deductions. And I know we talked about deductions. There's a lot of different things we can deduct. So when you change your facts, that's where you're really going to have an effect on your taxes.
Yeah. And just one more, I'll just kind of heap positives on here with kicking a dead horse, beating a dead horse. I don't know. But, also you're benefiting now and later with that. Whereas the tax deferred strategies, you're deferring, that money until later. So you don't benefit from it now. And in fact, a lot of times you can't touch it now, but then
limits
unless you want to accept a penalty for that. So, investing in real estate, investing in a business like a laundromat, you're benefiting now, but also you're going to benefit later in life too.
The opportunity. Yeah, exactly right.
I love that.
Because we dive into deductions. You think about deductions we can take as a business owner, right? Let's talk the easy ones, right? So if I'm a business owner, I'm spending more than my 500 hours, I'm going to get depreciation. If I buy a business, I'm going to get the equipment, and I'm going to be able to depreciate that. Just for a quick reminder what depreciation is. Depreciation is I spread the cost of an asset over a period of time. And that's the way the IRS wants me to do that. So I take an asset, for example, I buy a dryer or a washing machine. That's a 5-year asset. The IRS wants me to take that cost and spread the cost over 5 years and deduct it over that 5-year period of time. Right? That's what depreciation is. So when we talk about depreciation expense, that's what we're talking about. We're talking about what the IRS allows me to take of my original cost each year for an asset that I've purchased. I just want to make sure we're clear on what that is. Now, over the last several years, they introduced a thing many years ago with one of the tax bills. They introduced a thing called bonus depreciation. Bonus depreciation was at 100%. It went down to 80. This year, it's at 60% in 2024, which means any assets that I buy with a useful life of 10 years or less, I can expense 60% of those in year one, just right off. So think about it. I go out and buy a $100,000 laundromat business, and I'm going to just, for sake of arguments, allocate that whole $100,000 as all equipment. I can take $60,000 as a write-off the first year. The other $40,000 I'm going to spread over 5 years. That's a huge deduction when it comes to depreciation. So if I invested my 100, I'm going to get a $60,000 deduction off on my taxes. And if I materially participate, it's not considered passive. That $60,000 can be offset against W-2 or other business active income. Huge benefit to that with the bonus depreciation. Now, be advised it's 60% this year, and it's a tax law. And if I could understand why the Congress passes the laws and how they do it, I wish I could explain it all to you. But what they did is when they passed that law, they wanted to go down 20% each year until it's gone. And so it's at 60% in 2024. 2025, it goes down to 40%. 2026, it goes down to 20%. And then it goes to zero in 2027. Now, that's pending Congress doesn't do something different. Now, there's always a chance it would pass a bill that would make it and change those rules. But as it stands right now, that's where it stands. So depreciation is probably the biggest deduction when it's talking about buying a business. That's the biggest deduction, number one. But then there's other deductions as well. Things like my travel. If I have a home office, or I can take, if I'm going to review a business, or I'm going to look at business, can I deduct the travel and the hotel and some of the meals related to that travel to go do that? Those are all deductions. I have a home office deduction, which is, to me, it's a beautiful deduction. Now, one, you're going to hear from CPAs that say, don't take the home office deduction. They'll get you audited. You'll hear that when you talk to people. It is out there. The reality is there's a special form. It's a form 8829 that allows you to calculate your home office deduction. So it's not illegal. I'm not doing anything, that's bad. There's an actual form to calculate. If you do it the correct way, it can be a sizable deduction. What I love about it is you're taking part of your interest on your house, your taxes, your utilities, your insurance, all these things related to your home, and are now part of them is being deducted as a business expense where you're getting no deduction before. So I'm taking something I'm paying for already and changing it to be deductible. Love that, right? That's a home office. You talk about a vehicle. Maybe you have a business vehicle. You're driving back and forth and doing things. You can write off a portion of your vehicle. You got your travel expenses that you go and you can take deduction. Meals expenses, you travel away from home. Hotels, rental cars, that sort of stuff you get deduction. Because by owning your own business, you have a place now to take those deductions, right? And if we get into the S corporation, you have an advanced business, talk about paying your kids for doing work for you, right? They have to do a legitimate job. I'm not saying you should pay your kids for doing nothing, but the reality is, hey, I can employ my kids and I can legitimately employ them, have a job description, they do the work, I pay them. That's a write-off for my business. It puts money in their pocket. I get a deduction for it. Now, if you, me, and I, when you had teenage kids, you always have money going out the door. If I could pay them as a business deduction and get them money and make it deductible for me, that's a win.
That's a huge win.
Huge win. I had my kids, pay for their own school clothes, pay for their own. A true story. I had them pay their own way to Disneyland. They didn't like it very much, but I thought it was fantastic. Yeah. I paid them for work they were doing for me. Legitimately, I put it in their bank account. I treat them as an employee. I paid them an employee, gets direct deposit in their account. They use that money to pay for stuff like schooling, laptops, travel, clothes, all that stuff. And then on a side note, you're giving some education to your kids and teaching them how to use money. That's a win too. That's kind of sideline. No tax benefit in that. But man, if you can figure out how to pay your kids a legitimate salary for what they're doing, fabulous deduction.
Yeah, a couple of things on that. I just have notes on that. Number one is, essentially that gives you, 30% discount on Disneyland, essentially,
that's right.
Which is pretty sweet.
That's
right
true.
there.
I didn't think about that one. That's right.
Yeah, and also, what's a really interesting thing, and it's that you can do with your kids, right? Is if there's I forget the limits, like 13 grand or
Yes,
something like that.
Well, the first 13,000 as an employee they pay zero tax on.
Yeah. So if you only employ your kids up to 13 grand, you could actually take that money, throw it in a Roth IRA.
Yeah.
And that money is never taxed. It's going to grow tax free
for the rest of their lives
until they take it out. Yeah. It's going forever. So that's a huge, if you've got kids, that is definitely one to look at. If you can figure out a way to employ them to an extent where you can pay them 13 grand a year and just never, just throw it in a Roth IRA that goes in. It's tax free because they didn't make enough to be taxed on it, and then it's not taxed on the way out in a Roth IRA. So that's a huge. And
you didn't pay tax on it either.
And you don't. So
I didn't pay tax on it. My didn't pay tax on it, and he put the 5,000 limit into a Roth IRA. That $6,000 or $5,000 is never going to be taxed again. It's a beautiful thing. You hit that on the head, Jordan. That's great. And kids are great. And like I said, not everyone can figure out a way to pay their kids $13,000. I have clients that pay their kids $500, $1,000, something. Any money you pay them, that's a deduction for you. You're paying no tax on it. Because they're below the threshold, they're not paying tax on it either. Beautiful concept. I mean, that's it easy. Like I said, you got to be straight up. I mean, you got to be above board and write up a job description and what you're paying them for and how you're paying them. It's got to be legitimate. I've seen over the years, like I said, in my 30 years, I've seen people try to be super aggressive on that, and I do not encourage that. It's not the way to go. Give them something to do. Give them a job. It's good for the kids, and like I said, it gives you an opportunity to get a great deduction. So just some of those deductions, the home office, the vehicle, the travel, the kids, all these are all part of changing your facts. And like I said, we're creating more deductions in our business, which if we want to materially participate, then those losses can offset against my W-2. And that's where the real tax savings comes, right?
Yeah.
Because now I'm offsetting the active business income and I get the deductions. And like I said, not to mention, I have a business that hopefully is going to grow and make money and kick out cash flow going down the road. I mean, I get tax savings now and a cash flow asset that is perpetual, right? It doesn't go away. As long as I continue to make money, whether it's rental property or a business, that's going to kick out rents or income forever as long as I own it. So it can be a beautiful concept. I'm kind of lowering my taxes and building something that's making my wealth go up. So it's a fabulous thing.
Yeah. I love that. And, it is a huge perk to owning your own business, right? Like having the controls great, and having the ability to make, income that's divorced from your time, or at least independent of your time. But also this ability to have places to run deductions through. I feel like we get taxed when we make money. We get taxed when we spend money. We get taxed to own property, whether it be real property like real estate or personal property like washing machines. We get taxed on all that stuff. We get taxed by the federal. We get taxed by the state. It's like there's taxes everywhere. So anywhere that I can legally, obviously, reduce those taxes that I'm paying, I am a huge fan of.
Yeah, there's actually a date they actually calculated every year. I don't want to get that date in it's like usually April, May, where they figure you finally started working for yourself. Yeah. In other words, all the money you've earned up to that point has gone to taxes, and you're finally working. It's like April or May time usually every year where that comes. And you think about that, it just kind of boggles your mind that a third of the year, all I've done was work to pay taxes. Yeah, and that's depressing.
It is. Yeah. It's like, I think it's like the tax freedom day or something.
Yeah. Something like that. They call it something. Yeah.
And it's almost half the year that you're working for the government, essentially, which is really depressing, but it gives that perspective of like why this episode is so important, why what you do is so important, especially for business owners like us, in helping us push that tax freedom day, even, earlier in the year. I want to go back real quick to depreciation. And you did a really great job of explaining what depreciation is. And this kind of is going to help kind of merge us into the last little segment of our roadmap here. But on the sales side of selling your business, can you talk a little bit about what is depreciation recapture and how does that all work?
Yeah. So depreciation recapture is basically, it's just the way the IRS uses the term, and it is how income is taxed when I sell it. And the idea is if I've taken a deduction for depreciation up until the cost, as I recapture that amount of recapture is taxed at a different rate than long-term capital gains rate, which long-term capital gains rate, if you don't know, is a max rate of 20%. If your tax rate is lower than that, it would be lower, but a max rate of 20%. But the depreciation recapture is the amount I'm basically recapturing all that depreciation I took, and that money is going to be taxed at a little higher rate. So that's what that is, depreciation recapture is. Usually comes about when you sell something. If I've bought an asset, I've depreciated it, I've taken deductions over time, and I'm now selling it, okay, I'm going to get that recapture up to sell. Simple example to illustrate. I buy $10,000 worth of equipment, and I depreciate it down to $6,000. In other words, I've taken $4,000 of deductions. And I turn around and I'm going to sell that asset that now my basis in that is 6, because that's my 10 less what I've taken, and my basis is 6. Let's say I sell it for 12. Okay, so I'm going to recapture my depreciation back up to my original cost, which is $4,000, and then $2,000 is going to be long-term capital gains because that's above my original cost. So that's the way I have a total gain of 6 because I basis is 6, I sold it for 12. I have a total gain of 6. Of that 6, 4,000 is depreciation recapture, which means it's taxed at a little higher rate than the capital gains rate. The other last 2 is long-term capital gains as long as I've owned it for a year and a day. So that's why when people talk about depreciation recapture, that's what they're talking about. They're saying, okay, and to give you a little background, why it makes sense is when I took that depreciation, that was offsetting income of mine that was taxed at my ordinary rate, which maybe, let's say I'm in the top bracket. Let's say I'm in the 37% tax bracket. Those deductions were offsetting 37% dollars and saving me 37%. Well, if I turn around and sell those assets now, and the IRS says, hey, you took a deduction for that depreciation of 37%, it's not fair now that you get a lower rate when you get that money back when you sell the asset. And that's where depreciation recapture comes in. It's just, hey, back to my original cost, that amount is going to be recaptured and is taxed at a little higher rate. Anything above that is then capital gains, either long-term or short-term. Does that make sense?
Yeah, it makes perfect sense.
Yeah.
And I think it's worth noting, well, correct me if I'm wrong, but I think it's worth noting that depreciation is not an optional expense.
No,
for you.
You're right.
You actually are required to depreciate your.
They use the term allowed or allowable, in fact. So if you don't take it and you turn around and sell an asset and say, hey, I never took depreciation, therefore I don't have any recapture, the IRS, if you under audit, would argue, say, hey, just because you didn't take it, it was allowed and you didn't take it, it's your own fault. So you would not have that benefit. So it's allowed or allowable when it comes to the IRS. If they were to audit you and say, hey, you got to recapture even though you didn't take depreciation, which that would really stink. If, hey, I don't get the deduction and then I have to recapture it, that's a worst case scenario.
Yeah. Yeah. So, I just want to put that on people's radar.
Yeah.
I was not aware of that till my tax guy was like, oh no, we have, not that I was
have
to, but we have to take it.
To be fair, there's several different ways. The bonus depreciation we talked about, that 60%, that's an election you can take. There's a thing called Section 179 depreciation, which allows you to expense more of an asset. There's regular depreciation. There's different methods you can take to spread it out. So you can there's lots of different options when you choose to take in depreciation. But you're right, it's allowed or allowable. If you had the option to it and you didn't take it, the IRS will consider it your own fault. So yeah, you want to make sure you're looking at all the possibilities and what's going to be the best benefit for you.
Yeah, definitely.
That's a good point.
And I will mention too, one hugely powerful tool when it comes to depreciation, if you own real estate, is what's called cost segregation. And that's basically splitting it up into all its different assets and then maximizing your depreciation based on that. But essentially you can do something very similar with laundromats, by depreciating different things in your laundromat at different rates. Again, we don't necessarily have to go into what that all looks like, but that's something to ask about with your CPA, your tax preparer, your tax planner.
Yeah.
What different things in your laundromat are depreciable and at what different rates they're depreciable.
Right.
It can be a really powerful tool for you.
I totally agree. Because if you understand that if I can depreciate something faster, I only get to deduct the cost. But if I can get some of that cost into deduction earlier, just based on the time value of money, right? Because I'm saving taxes now versus saving tax in year 5. So getting what they call accelerating and taking that depreciation earlier through a cost segregation or something like that, I want to do that now because I want to save I want to have those tax savings because I can reinvest that money. And just based on that time value of money, that's better than getting a deduction 5 years from now. So yeah, that's a great point.
Yeah, I mean, it allows you to invest that money, that you're saving now versus later.
Yeah.
I mean, inflation being what it is, money's just more valuable in general today than it will be in 5 years.
That's true.
And possibly significantly. So
You're right.
on what rate we're going on, I don't know.
Yeah, you're exactly right. It's a good deduction just to invest anyway, but you think about the inflation piece of it, yeah, that makes it even better. You're right.
Yeah. So good. Okay, well, the last sort of stop on our little roadmap here, I want to talk about, we talked about like sort of the front end when we're getting ready to buy. I want to talk about the back end, and when you're thinking about selling or you're going through the process of selling, are there things, I always actually make the argument, even when you're just buying or you just bought or you're not even thinking about selling, you should be thinking about setting your business up to sell well, kind of from the beginning. But as you're thinking about selling, are there things we can be doing to sort of, position ourselves well on the sale end tax-wise?
There are. And there's a couple of things that I can think of as I've had to consult with clients that have sold business over the years. The biggest one is having good books and records, right? That's a big piece. If you always like Jordan, like you said, I always want to know what your exit strategy is. What am I going to do to get out of this thing? But having good books and records makes it look more enticing to a potential buyer, right? My books look good. I'm making money. Here's show my stuff. Everything's in order. Everything's accounted for. It looks organized. That sort of buying into a business that's run that way gives the buyer more confidence that they're buying an asset that is what it is, right? So when having good books and records, that is just a smart thing to do anyways, just because it's good for if you ever get audited or when you're getting your tax guy, whatever, that's just a good thing. But certainly when you're looking to sell, having those good records, a good profit and loss statement, a good balance sheet, everything ties out, everything makes sense. And being able to show that to a potential buyer would certainly gives you the buyer more confidence, one, and it allows you to get more money, right? Because when they look like buying a good existing business, everything's running really well, that just makes it more valuable to the buyer. So that's certainly one.
I just want to say that I did not pay you to sell. I've been preaching that message. We're not traditionally good at keeping good books and records in this industry. But I've been preaching that. I think a lot of sellers are leaving money on the table. And there's so many great tax advantages. You don't need to, skim off the top. You don't need to have bad books or anything like that to do well in this business. And, and I think on the back end, you're losing money by not having good books and records.
I couldn't agree more. Because when you go in and very much in like if you get audited by the IRS or a potential buyer, when they come in and want to look at your stuff and everything's organized and running and looks right, that just gives you, one, it allows the buyer that more confidence that they're buying something that makes sense. And if you get audited by the IRS, another thing, builds confidence. Hey, everything, this is all above board. I'm good to go. And like I said, certainly would help in that regard as well. But
banks and lenders also. Lenders love that. So it makes it more financeable, which means people can pay more for it because it's just a more attractive asset. So,
you're exactly right. Exactly. Yeah. I think you are leaving money. Definitely leaving money on the table if your books and records are poor. That's just a challenge. So if you're not doing that now, put it on your checklist to get that going, because like I said, we're only in May, or I guess June now. You go back and start in January and get everything caught up because like I said, it's just a big deal for that. Now, when we're talking about exit strategy and you're getting out of a business, there's really two ways to sell a business. And understand that everything's negotiable, right? So you got to import everything. There's 100 different ways to sell a business, but typically you either have an entity sale or an asset sale. An entity sale would be, hey, I have an LLC and they buy my LLC, which means they basically just step into my shoes. One day you're running it, the next day they're running it. They don't have to get new IN numbers, or employer identification numbers. It's just easy. It's easy for the seller. I'm just, hey, here's my LLC. It's done. They step right into your shoes. They're the new owners. Now, or an asset sale where they say, okay, I don't want to buy your LLC. I just want to buy the asset that it owns. Now, typically, a buyer is going to want to go that direction. And the main reason is because they want that depreciation. Think about it. If I buy into an LLC, all that depreciation has already been taken. I don't get any benefit of that. There's some special rules I can maybe get some benefit there a little bit. But usually an asset purchase is what they're going to want to do. And at that point, when you sell your business, you negotiate whatever that sale price is, what assets are included, what assets are not included. You would include that in your business. At that point, you'd write up a contract, and that would be either an outright purchase where they would finance and give you a check. Now, that's going to be gain to you. And the difference is the gain is calculated by what they call your basis, which means my original cost less any depreciation I've taken. That's my basis. And the difference between that basis number and my sales price is gain. And as I mentioned, some part might be recapture. Depreciation recapture might be. Any money above that would be long-term capital gain as long as I've owned the business for a year and a day. Now, there are other ways to sell business, things like an installment sale, which is basically, okay, hey, I'm going to sell it to someone. They're going to pay me over time, maybe on a contract for 5 or 10 years. Great.
Real quick, I just want to point out, common language for that is seller financing.
Seller finance.
Kind of what we're talking about here. This installment sale, seller finance. I just wanted to make sure we're
talking about the same thing. That's a good point, Jordan. So the idea is that basically I'm going to sell it. I'm going to hold the note, and they're going to pay me interest and a principal payment every year, and I'm going to pick up gain as I get money, as I get paid. Right now, there would be depreciation recapture in the first year. So you got to be careful on calculating what that recapture is, because that may be all gain in year one. So if you say, hey, I'm going to sell my business, I'm going to sell or finance it, I'm going to do this installment sale, I'm going to collect money over time, be aware there might be some taxes that first year you might have to cover because you don't have necessarily gotten paid for them yet. So you got to make sure that you're talking to your CPA and you're doing those calculations ahead of time so that you know that at least you get enough money in the seller, maybe the down payment or the seller financing portion, enough money to make sure you're covered for taxes for that first year. So you got to do that calculation. I think going into that is you're just asking for trouble, because all of a sudden you're going to be in this, you're going to come to your CPA in April. So, by the way, I sold my business a year ago, and I'm doing an installment, a seller finance for 10 years. Oh, yeah, by the way, you owe $100,000, and you haven't even got that much in payments yet. Big challenge. You got to be careful. You got to make sure you're running those calculations. And then, like I said, everybody's calculation is going to be different because everybody's done different things the way they, depreciate their business. But you want to run those calculations. But that's, from an exit strategy standpoint, as a seller, I always want to sell the entity. That's just clean and easy. It's just easy. But as a buyer, most of the time, in fact, rarely do I ever see anybody that wants to buy the entity. They want to start new. They want their new depreciation. They want to start that all fresh. And so they would buy the assets. But like I said, good books and records. When you start out, we're getting into that. So when you come to sell, makes the sell go down easier. And like I said, get you more money for your business.
Yeah, a couple of things I just want to contextualize here for Laundromat. So entity in an entity sale where you're buying the LLC, the S Corp, or whatever, not only are you not necessarily getting that depreciation, but you're also inheriting any potential liabilities from before you owned it. So almost never do you want to buy with an entity sale. You almost always want to buy an asset sale. But I also want to distinguish, because asset sale, at least in our business, gets used in two different ways. And you'll see this listed like on some of the listing sites sometimes, where they'll say this is an asset sale. Sometimes what they mean is exactly what Scott's talking about here, that this is an asset sale, not an entity sale, where they're selling the assets. But sometimes what they mean when they say this is an asset sale is they mean this business is not making money, and so we're just valuing it based on an approximate valuation of the assets of this business. So I just want to kind of distinguish the valuation versus the method of acquisition, because they get used interchangeably, and it can sometimes be difficult to discern what exactly they're talking about. So if you need help with that, that's a good opportunity to tap somebody on the shoulder who's got some understanding of these two things, to say, hey, what are they talking about here? Is this thing not making any money? Or, it's basically a fixer-upper, a laundromat, a zombie mat, or are they just saying, hey, this is the method of acquisition? That's
a great point. And like you said, I think you're exactly right. Usually if I'm consulting with the seller, obviously an entity sale is the easiest and cleanest. That's an easy way to go. But if I'm consulting with a buyer, I would always recommend never to buy the entity, because there's skeletons in the closet or whatever they got in their entity. You're inheriting all that, and you don't want that. So you want to buy the assets. You want to buy the assets and come up with a good value. It's a good distinction, that term where they use that interchangeable. that's a good point, Jordan. It's a point to make.
One question I want to ask you, because I think this is applicable both for the buyer and the seller, because there's always this sort of push and pull with this is, let's say our method of acquisition is going to be an asset acquisition, asset sale. And so typically that acquisition cost gets divided up into different assets, if you will. So that might look like equipment, that might look like what's called goodwill, or, different things like that. Can you talk a little bit about that and some of the implications of dividing those things up?
Yep, that's a good point, Jordan. And there's actually years ago, and I've been doing this long enough to remember, it was not uncommon for the seller to treat it one way and the buyer to treat the assets different. Now there's a special form. If you want to see the form, it's a form 8594 is the form. It's an asset acquisition statement, and that the buyer and the seller have to agree on how they're allocating that purchase price. How much is goodwill? How much is going to equipment? How much is going to inventory or receivables? You have to break that up, and you have to both agree on what that is. That's where the negotiation comes in. I'm negotiating how much is equipment, how much is goodwill. Now, typically, the idea of goodwill is taxed at long-term capital gains rate, which is that match 20% rate. That's a good thing. But again, and so for you as a seller, having more of the value equates to the goodwill is a better thing for you. But understand the buyer has the exact opposite incentive. He wants more associated to equipment, because equipment he can depreciate over maybe 5 or 10 years, or maybe with bonus or once money he can depreciate faster. Goodwill as a buyer is 15-year property. So it's longer time. So that's when the negotiation part comes in, because as a buyer, he wants more, or he or she wants more assessed to equipment versus goodwill. And for you, the seller, goodwill is a little better than the equipment because I have that depreciation recapture challenge. So again, that's all part of the negotiation point. And you fill out that form, that 8594, which each buyer and seller will have a copy of that. That's where the IRS confirms that both of you are treating it the same way. And that's where that form came in.
Yeah. And, the reason I brought that up is because when I bought my first laundromat, I was just like, okay, like whatever was suggested, I was like, okay, yeah, no problem. I didn't understand that there are significant implications as to what that allocation looks like, both for the buyer and for the seller. And so I wanted to point that out, because if you're looking to buy or sell, I want you to kind of understand what's going into that negotiation, because as a seller, there's tax implications, and you actually save money by allotting more of the asset value to that goodwill. And the exact opposite is true for the buyer. So that negotiation is important. And what I would say, just kind of generally on that is, listen, it is important. It's not a make or break. In most cases, it's not a make or break deal. And you do kind of want to be mindful in your negotiations that, hey, what benefits me is essentially bad for the other person and vice versa. And so, when possible, try to approach that with, some understanding, some empathy there.
Right.
But at the same time, you also need to stand up for yourself and fight for, valuation that does benefit you. So.
Yeah, and it has to be reasonable too. I've seen this more. I've seen several times where a buyer is trying to put stuff that's just unreasonable. You know what I mean? My class was a 2002 pickup truck that was originally $25,000, and now it's 20 years old, and he was trying to say the truck's worth $60,000. Okay, that's just not reasonable. No one's gonna. That doesn't even make sense. And so you have to understand the buyer's motivation, though, because if you can put more of that to that equipment, that's a better deduction for them. So you got to make sure it's reasonable. And like I said, you're right, Jordan. The right deal, it's not going to make or break the deal on that. I totally agree. Because if it's a good deal, it's a good cash flow, it's making money, it's good for those things. But you just certainly want to be mindful of those in the negotiation process. You don't want to just be, hey, whatever, can we at least discuss it? Let's make some concessions one with another and make it better for both of us.
Yeah.
That's good.
Yeah. Well, listen, we've covered a lot of ground already tax-wise. This has been really awesome, actually. So I appreciate you coming on and appreciate you sharing so much really good stuff for us. Like I said, I think that this these conversations, I mean, they translate directly to our bottom lines here, right? And, it's one thing to learn about the business, and that's great. But there's this whole other level of, on the tax side over here that can save you real money, and put real money in your pocket, and make a big difference in your life now, and also in the empires that you're building, going forward. So appreciate you coming on and doing this. I'm looking forward to, listen, we scratched the surface here. I'm sure that there are plenty other questions about taxes and stuff like that. So like I said, we are doing, if you're listening to this in time, we are doing a live Q&A on July 15th. Again, laundromatresource.com/events. We'll have all those details there. And then also, if you're on the email list, you'll get the email about that when that's a little bit closer. So make sure you come join us there. If nothing else, just to listen in, but come with your questions, because that's what that is all about. And we'll have a good time talking taxes over there. And Scott, man, thank you again for coming on.
Jordan, thanks for having me. It's been really fun. Like I said, I'm one of those weird guys that really loves taxes, and I just enjoy my work. So it's certainly been fun. And like I said, the idea of where I find the joy in is when I can work with people and save them money and make a difference in that. That's just very rewarding for me. Because I say, when you work for big companies, multi-billion-dollar companies, and you save them bottom line, and you're saving money for the shareholders, that's true. But when you take someone that's starting a business or running a business or with real estate, and you're saving them dollars right now, it's just fun to do. It's just fun to be part of that and be involved in that. So it's a fun project. Like I said, I just love part of it.
Well, I would make fun of you for being a huge tax nerd. However, I am just grateful that there are people like you that enjoy taxes, so I don't have to enjoy them. So I'm not going to make fun of you.
That's okay. It's all good. I've heard them all. That's good.
Yeah, I'm sure you have. But I look forward to hanging out with you again in a couple of weeks here, and hopefully a bunch of you guys who are listening here will join us there and put some more dollars in your pocket.
Yeah. So like I said, my company is called Provision. Our website is at provisionwealth.com, and you can sign up there. There's a free consultation you can get on and just click on a link and get right in to see what things that we can do to help. If you're interested, I certainly would be more than happy to help and talk about taxes, because as what we said at the beginning, everybody's situation is different. And so just to roadmap and say this is going to be the same for everybody, it's not. Not all deductions work for everybody. Not all plans or tax plans work for everybody. And so really working out a good plan for you that fits directly for you, it's just a big part of that. Because you can take snippets from books and podcasts and different things and try to apply those. But the reality is, when you come up with a really comprehensive plan that really is saying, hey, I'm using all the right entities, I'm using all the tax deductions, I'm doing all that. And that's a Provision. That's what we just totally specialize in, just really making a difference and just being proactive in it. That's where the name came from, is just being proactive at taxes and not just being so reactive, which is what 95% of the people are, just reactive to taxes. And we want to be proactive in that approach.
Well, I'm a huge fan of that. And, just kind of generally philosophically in my life, I want to try to be proactive in things and not let things happen to me, but make things happen in as much as possible. You can't control everything, obviously, but as much as possible. So I love that. And if you're in a position where you want to be a little more strategic about your tax situation, you want to put that plan together to actually keep more money in your pocket to help you build your empire, to change your lives, your family's lives, future generation lives. Provisions there. We'll have the link in the show notes, and we'll have also, if you're on YouTube, it'll be down below. And then we'll also, I'm sure we'll drop a link at the live Q&A also when that happens. So join us over there, but check out Provision. Like I said, one of the best things you can do to actually make a difference in your pocketbook. So Again, Scott, thank you, man. Appreciate it.
Hey, thanks for having me. I appreciate it.
I hope you loved that episode with Scott. Who would have thought that talking taxes could have been so exciting? I came off of that interview super pumped up. Cannot wait for that live Q&A. Hope you join us on July 17th, 4 p.m. Pacific, 7 p.m. Eastern, and talk more taxes with us. Get your questions in there for Scott, and I'll just be there, mostly for the eye candy or something like that. But as always, pick one thing and put it into action today. That one thing that you pick from this episode will translate to the bottom line for you. So pick something, put it into action today. Maybe go share about it on the forums, laundromatresource.com/forums. over there. And listen, we'll see you next week. Cannot wait. Peace.